Hello and welcome to this webcast. I'm Carlo Pereras. I am a member of the IASB's technical team working on the disclosure initiative Subsidiaries Without Public Accountability Disclosures project. This is the first of a series of webcasts for the IASB's future IFRS Accounting Standard for Subsidiaries Without Public Accountability Disclosures. In this first webcast, we will provide an overview of the new standard and its requirements, including why the IASB is developing the new standard. Let's have a quick look at the current timeline. The IASB has completed its deliberations and expects to issue the standard in the first half of 2024. The standard will have an effective date of 1st January 2027. However, should you wish to benefit from the standard earlier, you will be able to apply it once it is issued. So some key facts on the new standard. The standard is voluntary. The standard will permit eligible subsidiaries to apply IFRS accounting standards with reduced disclosures. This will be achieved by an eligible subsidiary by applying the recognition, measurement, and presentation requirements in other IFRS accounting standards, but replacing the disclosure requirements in those standards with the disclosure requirements in the new standard. This way, the standard will simplify the preparation of the subsidiaries' financial statements while maintaining the usefulness of those statements for their users. The IASB undertook the project following feedback in the 2015 agenda consultation. Stakeholders said that when a parent company applies IFRS accounting standards in its consolidated financial statements, it requires its subsidiaries to report applying IFRS accounting standards, because consolidated financial statements have to be prepared using uniform accounting policies. In the diagram, we refer to the subsidiary reporting to the parent using a consolidation pack. However, complications arise for subsidiaries when they are preparing their own financial statements. If they apply IFRS accounting standards, they have to give all the disclosures, some of which could be disproportionate or onerous for these subsidiaries. On the other hand, if they apply the IFRS for SMEs accounting standard or a local GAAP, there may be fewer disclosure requirements, but there are likely to be recognition and measurement differences compared to IFRS accounting standards. That would mean they need to keep additional accounting records to bridge the gap between their own reporting and the consolidated pack. Therefore, stakeholders requested the IASB to permit subsidiaries to use IFRS accounting standards, but with reduced disclosure requirements. Such a standard would allow subsidiaries to align their accounting policies with their parent while still maintaining the usefulness of subsidiaries' financial statements. The new standard will respond to stakeholders' requests by permitting some subsidiaries to apply IFRS accounting standards with reduced disclosure requirements. These subsidiaries will use the recognition, measurement, and presentation requirements in other IFRS and the reduced disclosure requirements in the new standard. The standard will be part of IFRS accounting standards, and as it will be voluntary, subsidiaries would be able to elect but will not be required to apply the new standard. The subsidiary and its parent could decide based on its own facts and circumstances and cost-benefit assessment whether or not to apply the standard. So who are the subsidiaries that will be eligible to apply the new standard? Subsidiaries are eligible to apply the new standard if they do not have public accountability, and the subsidiaries have a parent, intermediate or ultimate, that applies IFRS accounting standards in their consolidated financial statements available for public use. The eligible subsidiaries can apply the standard in their individual financial statements, or if the subsidiary is also a parent, like in the case of an intermediate parent, it would be able to apply the standard in its consolidated or separate financial statements. The description of public accountability is based on the description in the IFRS for SMEs accounting standard. That is, an entity is publicly accountable if its equity or debt instruments are traded in a public market, or the entity holds assets in a fiduciary capacity. To illustrate the scope of the new standard, let us consider some scenarios. In the first scenario, the parent prepares consolidated financial statements applying IFRS accounting standards, and its subsidiary does not have public accountability. So this is a straightforward illustration of the eligibility criteria. In this instance, the subsidiary is eligible to apply the new standard. In the second scenario, the facts are the same as the first scenario, except that the parent uses a local GAAP. Although the subsidiary does not have public accountability, it will not be eligible to apply the new standard because its parent does not produce consolidated financial statements applying IFRS accounting standards. In other words, it fails to meet one of the eligibility criteria. For a subsidiary to be eligible, it has to meet all the eligibility criteria. Let's now go to the third and final scenario. So here there are two levels of parents. There's an ultimate parent and there is an intermediate parent. The ultimate parent does not prepare consolidated financial statements. The intermediate parent, the one in the middle, prepares consolidated financial statements applying IFRS accounting standards. And then the subsidiary, the one at the bottom, does not have public accountability. In this scenario, even though the ultimate parent does not prepare consolidated financial statements, the subsidiary is eligible to apply the new standard. The subsidiary does not have public accountability, and it has a parent that prepares consolidated financial statements applying IFRS. In this case, the intermediate parent does so. Now, you may ask, in this scenario, if the intermediate parent does not have public accountability, is it eligible to apply the new standard because the intermediate parent in itself is also a subsidiary? So based on the facts in scenario 3, the answer is no. This is because the parent of the intermediate parent does not prepare consolidated financial statements. However, if the ultimate parent prepares consolidated financial statements applying IFRS, then the intermediate parent can also apply the new standard. The intermediate parent can apply the standard in its consolidated or separate financial statements. So here we illustrate how an eligible subsidiary will apply the new standard. Let's use reporting items of inventory as an example. For recognition, measurement, and presentation requirements, a subsidiary will go to IAS2, the IFRS Accounting Standard for inventories. For disclosure requirements, a subsidiary will go to the new standard, and it will be able to locate the disclosures it has to provide in subheading IAS2. The reduced disclosure requirements in the new standard are organized by IFRS Accounting Standard. For example, disclosures on share-based payment transactions are set out in subheading IFRS 2. Disclosures for business combinations are set out in subheading IFRS 3. Now, a note about the disclosure requirements. The disclosure requirements in the new standard will be a reduced version of those set out in other IFRS accounting standards. In making the reductions, the IASB applied the same principles for reducing disclosure requirements as it used when developing the IFRS for SMEs accounting standard. The IASB was able to make use of its previous work on the disclosure requirements for the IFRS for SMEs because eligible subsidiaries are a subset of SMEs. The IASB only used the disclosure requirements in the IFRS for SMEs as a starting point in developing the reduced disclosures. This approach meant the IASB was able to save time and resources. The IASB expects the main advantages of the new standard is that it simplifies and reduces costs of preparing financial statements because the new standard should simplify the group reporting process as the parent company and the subsidiary will be able to use the same accounting policies, and this will therefore remove the need for dual accounting, and subsidiaries will only provide fewer disclosures. The application of the standard would also likely improve the application of IFRS accounting standards, as knowledge of IFRS accounting standards should deepen throughout the group. And that ends this webcast. We hope you have found this interesting. In future webcasts, we will cover in more detail the expected effects of the new standard. To find out more about the project, or if you wanted to be updated on the IASB's work, you can follow us in any of the links shown in your screen, throughout our website or our social media pages, including X, formerly known as Twitter, YouTube, and LinkedIn. Thank you for listening.